And we are live. Welcome, everybody. It's great to see you coming to our Lunch and Learn today. Well, we don't really see you, but we're imagining that you're out there.
We can feel your presence.
That's right. Welcome, everybody, to San Diego's Lunch and Learn for the CCIM Chapter 2021, where we promote excellence, competency, and collaboration. I'm your host, Doug Tabor, board member of CCIM San Diego and rental property broker with KW Commercial. And of course, my wonderful co-host today is Miss Paris Moe, fellow board member and sustainability coordinator at Verdani Partners. How are you today, Paris?
I'm doing great. Happy to be here with you and glad to see you again, Bill.
Yes. Yes. Okay. So we have some housekeeping, of course. Our housekeeping today, as attendees, you are in listen only mode. Please, as you ask questions, use the Q&A box to submit all of those questions. Now, our speaker today is such an expert. He loves the tough questions, and he has asked that we don't hold the questions. He wants us to torpedo him right at him mid-talk. So be ready for that. Be ready to just shoot your questions out there, and we are going to be answering them on the spot. And this webinar, of course, is being recorded. So you will receive a link to the replay if you're unable to stay through the entire webinar, or you can check it out through the CCIM San Diego Chapter YouTube channel, where you can visit all of our previous webinars. Okay, our agenda today, pretty standard. 12 p.m. we are opening with introduction topic. We're going to recognize our sponsors. We're going to do a very brief audience poll, get an idea of who's in the audience today. We're going to introduce our speaker. Bill's going to do his presentation. Again, we're going to just forget about the 12:30 p.m. Q&A because Bill has, again, requested that we give him on the spot questions, which we're going to do. And we will be wrapping up at 1 p.m. today, right on the money. So a little bit about CCIM San Diego. You know, our chapter really focuses on providing real estate owners, managers, brokers, lenders, and other real estate professionals with a distinct industry advantage through education and networking programs like this one that promote the highest level of excellence, competency, and collaboration. You know, CCIM is a global organization. Membership is made up of real estate professionals really across the globe. And if you want more information about how you can earn the CCIM, the coveted CCIM lapel pin, which really is very helpful for your career. If you are looking to really expand your knowledge, this is an incredible course to become a CCIM designee. I went through it, and if I can get through it, trust me, if an old Marine Corps jarhead can get through it, you can get through it. It was tough, but the expansion of your knowledge to make you a better professional in serving your clients is definitely worth it. Not only for brokers, but for many folks in development side, on the lending side. So certainly check into that. If you want more information, go to our website, which is ccimsandiego.com. You can also check into our LinkedIn page, which is CCIM San Diego. And then again, our YouTube channel, we are just packing that with good, relevant information that you can utilize and also pass that on to your clients. If there's a topic in there that's relevant, certainly pass it on. And one other thing, as you can see, we're trying to bring in really up-to-date, relevant speakers. So if you have a good talk to present, or you know of someone that would make sense in this forum, let us know. Drop us a line. You know, it's always good to bring relevant speakers, especially San Diego related commercial real estate investment. All right, let's see where I'm at. Now, I'd like to take a moment to really thank our sponsors for 2021. You know, sponsorship is very important, especially in the era of COVID. And we are just so grateful to have the continued support of these wonderful organizations. Of course, Heck Solberg, Marcus and Milchap, Savills, and PMB Advanced Healthcare Real Estate. They are our platinum sponsors this year. Our gold sponsors are CoStar, Exeter 1031 Exchange Services, who is also our speaker today. Bill, thank you for your continued support of CCIM San Diego. SCS engineers, and our friends over at Slat Capital. We really appreciate the support, and you know, what can we say? Sponsorship is so valuable for us to keep us going, to continue to provide these events for 2021. Okay, so now you know who we are. Let's get an idea of who you are. This is where we take a poll to find out who is in the audience. We don't get to see you, so this is a way for us to kind of gauge who is attending. So take a quick moment and complete the poll and let us know who is watching today. We have a pretty good turnout. I believe close to 100 folks have turned out for this event today. And we are delighted that we've been able to continue these lunch and learns for the last year and really double our turnout. You know, when they were live, of course, they were about half that on a consistent basis. So the nice thing today is that with the digital age, we are able to present to a lot more folks. So the horse race is running. I'm watching the numbers go back and forth, and there's a close race between owner investors and brokers. But it looks like, as usual, the owners investors have taken the lead and have won the race. So our audience is primarily consisting of owner investors today, second by brokers. We have a nice chunk of property managers in the audience today. Welcome. That's always good to see. And then we have our lenders. We have a few developers. And then there's the other group. Not sure who the other group is, but you're always there. And we are grateful to have all of you guys attend. We just have an excellent presentation today, especially with what is going on in this industry. And what I'm really excited about is the fact that 1031 exchanges really affect all of us. So our presenter today is Mr. Bill Exeter. Bill is the CEO and president of the Exeter Group of Companies. Bill has been in the banking, trust, and fiduciary services industry since 1980. He began specializing in real estate tax strategies in 1985. The glorious 80s, Bill. Gosh, I miss the 80s. What I always love to introduce Bill Exeter with is he through his company, Exeter Group of Companies, they've completed over 125,000, yes, 1031 exchange transactions over the course of his career. So if you have questions about 1031 exchanges, this is the man to ask. They are a nationwide company. They are based, luckily for us, here in San Diego. So without further ado, I am going to pass this presentation on to Mr. William Bill Exeter. Bill, how are you doing today?
I am good. Thank you. How are you guys doing?
Fantastic. Doing great. And we are delighted to hear you answer all the difficult 1031 exchange questions. So the floor is yours, my friend.
Perfect. And hopefully if I did it right, you can see my full screen.
We can see it.
Perfect. Well, good morning or good afternoon, depending on where you're located. And, you know, for today, we were kind of doing an update. So I kind of named it Trials, Tribulations, and Trends. And I just thought we'd cover a number of different things that we see going on out there in the industry that affect all of us here. First, for those of you who have not worked with us before, Exeter 1031 Exchange is a qualified intermediary. We cover all 50 states, all types of exchanges. We've been doing this for a long time, like Doug said. This is my 36th year doing it. So we've seen a lot of crazy transactions out there. And a few years ago, we added to our family of companies, Exeter Trust Company. So that means we're one of the few qualified intermediaries that is now subject to government oversight. Most do not have government oversight. So we're one of the few that does. And you can see that it's rolled out or allowed us to roll out a few additional products there. So we can actually hold the 1031 exchange funds in a qualified trust account. We now offer self-directed IRAs, title holding trust or land trust, specialty holding escrows, and then of course the self-directed custody accounts. So with that, I thought we would just kind of talk about 1031 exchanges, things that we see out there, trends, but I thought I'd start with the threat to 1031 exchanges. That's the area we're getting the most questions on from most people, and really kind of address, you know, what that issue is, what it looks like today, and kind of where it came from, et cetera. So it really started back in March of 2020. This is back when it was the Biden campaign. And at that point, they had kind of started rumblings of various tax policy changes they were looking at, one of which was to limit the use of a 1031 exchange transaction. And of course, they were vague on details because at that point it was just a campaign. But it looked like what they were targeting, and even today, the way they are, discussing certain policy changes, they're focused on this magic threshold of $400,000. So, if a taxpayer, if an individual makes greater than $400,000, there's all sorts of issues they're targeting that would affect that taxpayer. And if they make under $400,000, then most of their proposals probably won't impact them. So sticking with the 1031 exchange topic, the proposal effectively is that if the taxpayer makes more than $400,000 in a given year, they would not qualify for a 1031 exchange transaction. And if they make less than $400,000 per year, they would qualify for a 1031 exchange. The challenge, of course, is, if you're a married couple, you got two incomes probably, and you've got interest and dividends. You sell real estate, you've got a capital gain, you've got depreciation recapture. So especially here in California, if you sell real estate, it can very easily push your adjusted gross income over $400,000 just for that 1 year if you're not already over that number. So in that case, you wouldn't qualify for 1031 exchange treatment. Having said that, though, there's been lots of proposals over the years. Back to President Obama's administration, his proposal really was a cutoff, or the threshold was at $1 million. So it depends on what happens and how this may or may not roll out. A lot of folks are asking, why would they consider this? And it's really a pay for. They've got a lot of stimulus programs that have come out. They've got some planned or proposed stimulus packages that are being talked about. And when you're spending this kind of money, obviously somehow you have to pay for it. So they consider programs like this a pay for. Effectively, the analyst in the back office has written a little thing that said, hey, if we erase Section 1031 exchange, look at all this incredible tax revenue we're going to collect. And as we go a little further, you'll see that's not actually what happens. That's not the impact that it would have. So it really is effectively an elimination of 1031 exchanges if they stick with that $400,000 threshold. So what would happen? Well, that's where the administrations and Congress really don't understand how a 1031 exchange works. Folks sell investment property, rental property, property used in a trade or business, and reposition because they can defer the payment of taxes. If they couldn't defer the payment of taxes, they probably wouldn't sell. And we've done surveys over the years, and depending on the level of tax rates, usually 60% and above, sometimes as high as 80% say, if I couldn't defer the tax, I wouldn't sell. So the issue there, excuse me, is if you've got 60 to maybe upward of 80% of these transactions that just won't sell, now you have two title companies, two escrow companies, two real estate firms, two lenders, two appraisals, exchange companies, et cetera, that do not get their transaction. They don't collect revenue. They don't pay taxes. So if you go down the line, it's really a revenue loser as opposed to a revenue raiser. So that's what really would happen if 1031 exchanges were eliminated. It has a huge impact, not just on the 1031 exchange industry, not just on the real estate industry, but on the entire economy. We've got some surveys we'll talk about in a minute that kind of bring that home. The thing to keep in mind is this is not a political issue. I've been doing this for 36 years. Every, say, 3 to 5 years, something comes up. I would say almost, not all, but almost every administration and every Congress has proposed some type of reduction, change, or elimination to Section 1031 over the years. Most of the time when you sit down and say, look, this is what the impact would be, they usually back off. So it's really an educational issue. Every time this thing comes up, we need to sit down, we need to educate Congress, we need to educate the administration on how 1031s work, what the impact would be if they actually did eliminate Section 1031 exchange. Excuse me. So part of this education is on the bottom of this slide here, where it really, they need to understand that the 1031 exchange puts a lot of, or creates a lot of liquidity in the market. It stimulates business and real estate activity by allowing properties to buy and sell without getting hit with taxes. It allows businesses to transition, to grow, to build, to reposition. And today, after COVID-19, a lot of businesses, a lot of property is going to have to be repositioned or repurposed, especially if you look at the retail sector, maybe even the commercial office sector. And to be able to repurpose or reposition without incurring taxes is going to be critical going forward. So it really allows the industries and the businesses to make sure the property is being used at its highest and best use. So that's really the educational tool that we need to get out there in front of Congress, et cetera. In fact, I didn't put it on the slide, but there's about 16 different trade groups today that have already formed a coalition. In fact, it was formed probably maybe about 4 years ago, I guess, when the last threat came up. And successfully defeated that threat to 1031 exchanges. They've, of course, gotten together again, and they're now educating Congress and they're educating the administration on what this is all about. What does it really mean? What's the benefit of a 1031 exchange? And what's the downside if you actually eliminate that? We kind of joke that this trade group or this coalition is actually getting really good at this educational process. So it's sad to say we have to do that, but they're actually really getting really good at it. So having said that, there's two studies that were done last time, and they've both been updated for this time. And the one is by Ernst & Young. And they were asked, if 1031 exchanges were eliminated, what would the outcome be? And there was a number of opinions and outcomes that they mentioned in the study, but the big one to me was if Section 1031 was completely eliminated, GDP would drop by 0.8%. Now, this is back in 5 years ago with the last threat, but at that point in time, GDP was running around 1.9%. That's almost a 45% decrease in GDP just by eliminating 1031 exchanges. So it's not just a real estate issue, it's an economic issue. It affects the entire economy, not just the real estate industry. That was more of a macro study. And then Ling and Petrova came out around the same time, and they did a micro study. They had a number of interesting findings during that study. They actually had worked with CoStar and a number of other databases, and they really analyzed a phenomenal number of 1031 exchange transactions. And what they found is that most investors that go through a 1031 exchange are 33% more likely to invest capital in the replacement property, meaning they're going to spend money, they're going to improve, they're going to retrofit the property. So it actually stimulates the economic activity quite a bit more because they're exchanging into a better property that needs improvement, and they want to make that property better. They also found that 88% of those transactions that were structured as part of a 1031 exchange ultimately became taxable down the road, meaning somebody eventually cashed out and just paid the tax, and they didn't hold until they passed on. So it eventually allows the investor to grow their net worth, build their values, and at some point in the future, they sell, cash out, and pay the tax. The other thing that we didn't mention here really, but we've seen it in all of our transactions, and I think every qualified intermediary would agree with it, is that a lot of times when you, in fact, it's probably 80 or 90% of the transactions, when you sell, you've got certain items on your closing statement that are non-permissible exchange expenses, prorated property taxes, prorated rents, HOA fees, et cetera. You've got lender-related costs, demand statement fees, loans fees, points, et cetera. Those can be paid through the closing, but they're going to trigger taxable boot. So when you do a 1031 exchange, there's almost always a little bit of tax consequence to these transactions. So that generates a little bit of tax on every single transaction. So if they eliminated 1031 exchanges, the number of transactions would drop significantly, and it's actually a revenue loser for the government. If they continue with the 1031 exchange, it's actually a revenue raiser because of the topics we've just mentioned. There were certainly a lot more topics in these studies, but these are just the ones that I wanted to highlight. Excuse me, forgive me, I'm getting over a nasty cold here. So what do we expect going forward? Having said that, I've been doing this for 36 years, again, as I said, and this threat comes up every 3 to 5 years. We've always been able to extinguish the threat through education, but we have to take every threat seriously. We have to continue fighting it hard and educating them. So we're going to continue that battle. We've already got the coalition together. We're already educating Congress and administration. The positive is it was not part of the $1.9 trillion stimulus package that was just passed recently. We expected to see something in there perhaps, and the fact that it was not in there is a really good sign that we're already making progress with the battle. And most of the lobbyists we talk to, including NAR's lobbyists, they don't think we're going to see any new real solid tax policy changes until probably the fourth quarter of this year, maybe the first quarter of next year. The follow-up question we get quite a bit from investors and taxpayers and what have you is, if it were to happen, worst case scenario, they did change, reduce, limit, or eliminate 1031 exchanges, when would that be effective? And the answer is, of course, nobody knows, but tax policy changes are very, very rarely retroactive. It would be devastating to undo all these transactions that people thought they'd accomplished. So we don't expect any kind of a backdate or retroactive or anything like that. Most likely, if the changes occur, it's normally effective the date the legislation is introduced, the first day of the following tax year, something like that in the future. So we think even if they do introduce this, and even if we don't win the battle through education, we've got a couple of years before anything would really hit hard. But those are just kind of our thoughts as to where this would go. And it's kind of what a lot of the lobbyists have addressed as we talk about it. So with that, that's kind of the threat to 1031 exchanges. If you have any follow-up questions, go ahead and post those. I'd be happy to take them. I wanted to get into trends and what we're seeing in the market today from a 1031 exchange perspective, and then specifically from a qualified intermediaries perspective. So we have certainly seen, with COVID last year, we've seen a lot of pent-up demand. A lot of people were either getting ready to do deals or were in the middle of trying to do deals, and then COVID hit. We all got locked down. We've seen a lot of stimulus packages, checks going out, PPP loans, and whatnot. We've seen all sorts of infusions into the financial and capital markets. So there's a lot of cash sitting out there waiting for somebody to do something with it. We have phenomenally low interest rates today. We have the threat to 1031 exchanges, and there are investors who are worried, what if this actually occurs this time? We do not think that would happen just based on experience and what we've seen in the past, but is it a possibility? Sure, it's always a possibility. We have a lot of people who need to reposition or retrofit or repurpose properties because of COVID-19. We have the California exodus where a lot of folks are exchanging out of California. On the other side of that, the flip side of that coin, yes, we have a lot of people selling and moving out of California, but there's also a buyer. So we've got people who are buying. And I'm beginning to hear the term another roaring 20s. So that's kind of what we're seeing out there. I can say from our specific operation, the transaction volume for 1031 exchanges has exploded. It's tripled since August or so of last year. So we've seen a huge increase in 1031 exchange activity. We've also seen a huge increase in rush transactions. People are getting, of course, cash offers and their 10 or 15-day closings. People are trying to get their tax advisors lined up, and we're in the middle of tax season. So a lot of folks are making last minute decisions the day before, even the day of. I spoke to someone yesterday who called in and she said, I need to do an exchange. And the question is, when are you closing? She goes, in 5 minutes, literally. So we have those type of rushes that are occurring. We're seeing a huge increase in smaller transactions, smaller equity, single families. So a lot of people, now that they're past the lockdown and they're getting ready to do deals, we're seeing a huge increase in the smaller activities and what have you. What do we think we're going to see going forward? We think that's going to continue. I don't see any reason why it's not. Our pipeline looks very, very strong. Our pipeline actually looks like we're going to continue to see an increase in businesses or in business activity. Today, this is going to be our best month ever in the history of our company. So you can just see that it's been a phenomenal amount of 1031 exchange activity. We think one of the things that impacts our industry the most is the significant reduction of interest rates. Qualified intermediaries make their money on a setup fee and also on the revenue sharing, or the float, if you will, or interest rates. And obviously interest has dropped considerably. So 80% of the qualified intermediaries' fees have dropped. So you'll probably, if you haven't already seen it, you'll see some increases in qualified intermediary fees. You may even see some of the exchange companies begin to charge rush fees. So that's really the trends that I've seen specifically in the 1031 exchange arena. I wanted to address kind of the challenging market that we're in. And we got a lot of pre-event, pre-webinar questions that were somewhere around this area. So the questions always surround, I'm selling property, I'm doing a 1031 exchange. How do I deal with this type of a market? I mean, we've got a very fast-paced market, very low inventory. You're getting multiple offers and bidding wars. It's certainly a seller's market, the seller's in the driver's seat. So when you're doing a 1031 exchange, how do you deal with that? It's very difficult to not only locate a suitable replacement property, but identify it as part of the 1031 exchange, do your due diligence, bid on it, et cetera, and win the bid and acquire the property. And so that's really the risk, is what happens if I sell and I can't identify, can't close on replacement property. So I quickly wanted to talk about identification issues. A lot of investors, have focused on over the years that the 3 property rule, which is by far the most common, is the identification process they use. And the reason they use that is, number one, they're selling. And I should probably back up. So if you sell and you close today, tomorrow is day number 1. That triggers your 45 calendar days in which you have to identify your replacement property. Most people are selling one asset and buying one asset. So they're trading equal, or probably trading up in value to increase their portfolio, or they're buying multiple units, more doors, more cash flow, what have you. And they're trying to increase their net worth. And so they'll use the 3 property rule, where they identify 3 properties, probably with the intent to buy one. The second and the third are backup properties in case the first one falls out. Well, that works great in a normal market, but when you've got a market like today, it's an extremely fast-paced market. And if the first property you really want, your target property, is not available or falls out of escrow or what have you, the second and third properties are probably long gone. So the risk today is you're doing a regular forward exchange, you sell, you've triggered your gain, and for some reason you can't identify, can't acquire replacement property. The exchange fails, and that's a taxable event. So for today, the risk is, of course, tax consequences. It is still a seller's market. So there's some strategies available when it comes to the seller's market. On the buy side, that's where it gets extremely difficult, because it's not a buyer's market, it's a seller's market. So I wanted to talk about some of the potential solutions that you can use. Now, a lot of these are not necessarily ideal, especially in a fast-paced market like we have today, but it'll throw out some ideas that you can use or tweak depending on the circumstances. So keep in mind, the big issue from a 1031 exchange perspective is when the sale closes, that triggers your timeframes. That triggers your 45 days. It triggers your 180 days, et cetera. If we can find ways to either slow down or delay the close of the sale transaction, or we can speed up the purchase of the replacement property transaction, we might be able to solve these things. So contingencies, you can certainly offer contingencies, make it contingent upon both properties closing. You can request they close concurrent. Sellers of the replacement property are probably not willing to cooperate, but some will. So that's a possibility. Remember, it's a seller's market. So when you sell property, you can notify the buyer that we're doing a 1031 exchange. I need your cooperation. If you're willing to be cooperative with us, we'll cooperate with you. You might be able to get a long-term escrow. You may be able to get options to extend the close of escrow, things like that. As long as you haven't closed, you haven't triggered your 45-day window. So that's really the key. Start looking for property, your replacement property, sooner rather than later. I understand that the property may be gone and snatched up in a heartbeat, but if you find property you like, you might be able to tie it up somehow, maybe with a long-term escrow, maybe with options to extend, maybe with a lease with an option to buy or just an outright straight option to buy. It depends on the seller's pain point, what they need to solve for, but it may be something if you cooperate with them, they would be willing to cooperate with you. So if we can find some way to tie up the replacement property and then get you time to coordinate the two closings, that would certainly help. One of the possible transaction structures is a reverse 1031 exchange. That allows you to go out and acquire your replacement property first. So you actually close on your replacement property before you sell your current property. It eliminates a lot of the 1031 exchange risk because you know you've closed on it, you know you've got it. You don't have to worry about whether or not you could find replacement property. The downside is they're more complicated because one of the two properties, either the one being sold or the one being acquired, have to be parked or held by the qualified intermediary. That means we set up an LLC to acquire and hold or park legal title to one of those two properties. So it's more complicated. There's more moving parts. In certain cases, lenders are not going to be willing to work with those. And there's more costs involved as well. But if you can buy first, and especially if you're in a position where you can pay all cash for the new replacement property, a reverse 1031 exchange could be ideal for you and solve a lot of those issues, take a lot of the risk out of the closing. You could also look at, if you sell first and you're doing a regular 1031 exchange, maybe look at a Delaware statutory trust as a backup identification for your property. Some people love those because there's no management involved, et cetera, et cetera. Other people want to have control, but as a backup identification that should be there should your target property not be able to close, that may be a great way to at least defer the taxes and save your 1031 exchange. Of course, the bottom line is sometimes it's just better to pay the tax. So it depends on your circumstances. It is also possible to combine different types of 1031 exchanges. So you might be able to start with a forward 1031 exchange and go into a reverse, or start with a reverse and go into a forward exchange. For example, let's say that you are selling a $5 million asset. You're looking for replacement property and you find a $10 million asset that you really like. And you think, wow, I'm selling 5. I really don't want to have to finance or pay cash for the extra 5 in value. I'd really rather sell a second property, but I don't have time to do that. You could sell the $5 million asset. When the closing occurs on the replacement property, we can split it or bifurcate it. So part of the value is allocated to the forward exchange and we close out the forward exchange. And the balance, the other $5 million in value, could be used to start a brand new reverse 1031 exchange. So now you have another 45 and 180-day window to find a second property that you can sell and use to finance or pay for the $10 million asset you've acquired. So there's different ways to add and reposition different types of exchange strategies to accomplish various goals when you find yourself in one of those scenarios. So that's kind of the solutions we've seen out there that might help in dealing with this type of a market. If you have any other follow-up questions on that or potential structures, be happy to chat about that. The next one I wanted to talk about real quick was California. California's issued, or the California Franchise Tax Board has issued a notice. It's notice 2019-05. We're not getting a whole lot of questions on these, but we get a few every month. And the questions are something along the line of, can I implement one of these installment sale programs that are out there to back me up, to save a failed 1031 exchange transaction? So they'll talk about things like the monetized installment sale, the deferred sales trust, the self-directed installment note, things like that. These are programs where effectively, they're all a little different, but they're all drafted under Section 453 of the tax code. So they're all drafted where you sell your property to an entity, to an intermediary, to a dealer, whatever they call it. And in return, you get a seller carryback note effectively. You get an installment note, and then you get payments over a period of time. And I'm going to ignore whether that does or doesn't qualify for a regular transaction. But as part of a 1031 exchange, the IRS has come out and said, if the taxpayer, more specifically in the notice, which is directed to qualified intermediaries, if the qualified intermediary facilitates or participates in using one of these to facilitate or wrap up or save a failed 1031 exchange, the qualified intermediary will be held liable for withholding penalties. And I've got a quote there right out of the Franchise Tax Board's ruling that says, qualified intermediaries subject to failure to withhold penalties if they participate in quote unquote improper like-kind exchange transactions. So that's just to let you know that qualified intermediaries won't work with these type of structures because they are personally subject to liability for failure to withhold. So I've given the notice there in case you want to just Google it. You'll find it out there and you can kind of read up on what that is. It's just a 2-page notice. It's pretty easy read.
So it seems like we got our first live questions. Would you want to answer how to exchange forward into 2 assets after selling one?
Good question. So that's a good question because a lot of people, especially investors, are under the impression you have to sell one and buy one. That's all you're allowed to do. And it's not the case. You're actually allowed to sell multiple and or buy multiple properties. So if you're selling one, you want to buy multiple properties. Generally, it'll be part of the same 1031 exchange, of course. You sell your asset, it triggers your 45 days. During the 45-day window, that's when you would identify those 2 properties. You can allocate the equity that comes out of your sale any way you want. So it does not have to be an even split. You could buy one with all cash and the other one could be mostly debt and a little bit of cash. That doesn't matter. They just look at the total purchase price of what the total 2 properties were acquired for. So as long as the combined value of the 2 are equal or greater than what you sold, that will satisfy the reinvestment requirements. It's the identification process. The more properties you want to acquire, the more tricky the ID process becomes. So if the 2 properties you're looking at are, probably equal or greater than what you're buying, you're probably going to use the 3 property rule. If you're going to sell a large asset and buy a whole bunch of smaller assets, perhaps more than 2, you may want to look at the 200% rule. And the 200% rule says, let's say you sold an asset for $5 million. The 200% limit is double that, so 10 million, that's your 200% limit. You can identify as many individual properties as you want up to a total of $10 million in value. You don't have to acquire that, of course. You only have to reinvest the 5 million because that's what you sold, but it allows you to identify multiple properties to look at and go through due diligence on, et cetera. So hopefully that answered your question. You sell the 1, buy the 2, identify the 2, close on the 2. As long as you close on those 2 within that 180-day window, you'll be in great shape. And if that didn't quite answer the question, go ahead and post a follow-up question. Be happy to expand on it.
Perfect. And any thoughts on the proposed changes to the step basis and how that might affect 1031 exchange volume and overall sales?
Good question. That's certainly one of the other items that is on the proposed list, is to eliminate the step up in cost basis, things like that. And I think that's probably very closely related with the restrictions or limits on the 1031 exchange side. So I think it's going to probably reduce the number of transactions because the 1031s could probably go away if that happens. On the other hand, if the step up in cost basis goes away and the 1031s remain, then we'll still, I think, see a lot of increased 1031 exchange activity getting ready for passing, so the kids can kind of pick what they want to inherit. But I personally think that both of those through education will probably not happen. We're kind of operating in uncharted territories at this point because we do have the Democrats in control of the administration and for the most part in control of everything else. But there are a lot of Democrats who do 1031 exchanges and own a lot of real estate, and it's going to have a significant impact on them. And they don't necessarily want to be the one that potentially really votes for something that hurts the economy. So my comments back on eliminating or the threat to 1031 exchanges, a lot of the comments are applicable to the elimination of the step up in cost basis.
Got it. Thanks, Bill.
You're welcome.
And another question is, how do you coordinate close of escrow date when there are multiple owners on both the seller and the buyer side?
Good question. I'm not quite sure where they're coming from on that question. I assume if you're trying to close concurrent issues, concurrent closings, the sale and the purchase, et cetera, it can be challenging. The more parties involved on both sides of the transaction, the more difficult the closing is. Fortunately, especially in California, where you have an escrow-driven state, almost everything's prepared in advance. And then with e-signatures, it's become a lot easier, but it's still kind of like herding cats. So it can be very difficult to do that. When folks call and ask, can I close concurrently? My thought is, number one, if you close concurrently, that takes the risk out of the 1031 exchange because everything is closed on the same day, it qualifies. The challenge is that what if something happens to your sale and it's delayed, maybe a day or a week or two, or there's a defect of title, or something comes up, the lender has an issue on the buy side, whatever. If there's a delay, that could cause problems when you're trying to close concurrently. So those are all the moving parts, multiple parties, and then anything that might go wrong in the transaction. So I always recommend trying to do maybe a 1 or 2 weeks between closings. So especially if something happens on the sales side, you've got time to address the issue, clean it up, fix it, whatever that might be.
Thanks, Bill. That's all for now. And to our attendees, feel free to keep the questions coming.
Hey, Bill, it's Doug. I have a question. Along the lines of multiple owners, multiple investors, I often get asked by folks that are maybe in an LLC, they're in some sort of partnership that was created decades ago. And you always get, a couple of the investors get approached to sell their property. One side of it wants to cash out. The other investors want to do a 1031 exchange. How do you handle multiple investors that are coming out of that type of entity structure?
That's a really good question. And that's probably the most complicated part of the 1031 exchange world. And I do have a slide coming up on that. So if I could defer the question, if that's okay.
That's perfect.
The next two slides, or actually next three slides, are talking about qualified use and like-kind property. And some of this is pretty basic, but the reason I bring this up is kind of going to where Doug's question is going to lead me. And that is, what property qualifies, what doesn't? And a couple of the pre-event questions that came in were talking about how long do I have to hold title to the property before I could do another exchange, or before I could move into the property, or things like that. And so I wanted to kind of bring this back. And this is probably the most critical slide in a 1031 exchange transaction, which is qualified use. All the properties you're selling, all the properties you're buying as part of that 1031 exchange have to be held for some type of rental, investment, or business use activity. That's the critical part. And that's where there's a lot of misinformation out there. And a lot of investors, even a lot of advisors, get hung up on, well, how long did you hold title to the property? People will tell them, well, you don't qualify because you didn't hold it for at least a year. So the first thing is the tax code, the regulations, the rulings have absolutely no holding period required. There's none. There's nothing in the regulations that say you have to hold it for a year. But what you hear a lot is you have to hold it for a year and a day, 18 months, 24 months. It's important to know those are opinions. It's not fact. It's not a requirement. Now, the reason you get those various opinions is the longer you hold title to the property as rental or as investment property, the easier it is to prove intent. But the real issue is your intent. If you get audited, the investor has to be able to prove they had the intent to hold the relinquished property and the replacement property for some type of rental, investment, or business use. That's really the key. So it all boils down to your intent and what you can prove. So having said that, some investors are in the business of buying real estate, and they're either fixing it up, rehabbing it, building it, developing, converting, and then selling. All of those activities are buy, do something to the real estate, and sell. So they're really holding for sale. They're holding as inventory in their real estate business. Those typically don't qualify for 1031 exchange treatment. Now, if they were to buy, do whatever they're going to do to the property and then hold, it would qualify. So it's all about, did you intend to hold for investment purposes, or did you intend to do something and then sell it and effectively flip the property? And so that's what it boils down to, is if you're audited, can you prove that you had the intent to hold it for investment purposes? And people get hung up on the length of time. So having said that, let's talk about the holding period. And let me give you some examples that kind of bring this home. First of all, most advisors recommend 12 months, 18 months, 2 years, etc. Again, those are opinions. If it's a plain vanilla transaction, I think a 1-year holding period is probably sufficient. It straddles 2 tax returns. It's going to show you intended to hold for investment purposes, and then you move on and do another exchange. But if you're going to push the envelope, if you have, going back to Doug's question, if you have partnership changes or entity issues, if you did live in the property or you're going to live in the property in the future, so it's a little outside the box, you're pushing the envelope, I'd probably recommend holding it for 2 years as rental or investment property, which straddles 3 tax returns. That's really solid proof that that was your intent. There are court cases where they didn't address the holding period, but the holding period was about 2 years, and they've always been allowed. So we do know a 2-year holding period has never been thrown out by the court. So, but it doesn't mean you have to do that. So it really boils down to, what are you doing? What kind of risks are you taking? Are you pushing the envelope, or is it plain vanilla? And then you decide what you're comfortable with. But the length of time you hold the property as rental or investment, the easier it is to prove intent. So having said that, let me give you a couple examples. There are 2 tax court cases where both individuals were developers. These are completely unrelated cases. Both were developers, both bought dirt, both intended to develop single family homes. Neither one developed anything. Both held the dirt. One held for 12 years, one held for 20 years. Both ultimately ended up selling, doing exchanges. Both got audited, and both were disqualified. It shocked the industry because that was a long-term hold, and everybody always thought a 1 or 2 years would be fine. The issue is their intent was to buy, develop, and sell. It was always held for sale, not held for investment. Now, the key issue there is intent can change. So they could have said, you know, my business model has changed. The real estate market has changed, whatever it might be. Something triggers it. And they can now say, you know, I'm not going to build on these properties. I'm now going to hold these for investment. And then as soon as it hits a certain point, I'm going to sell. And if they had changed the way they reported the properties on tax returns, financial statements, loan applications, things like that, as property held for investment instead of property held for development, they could have qualified. On the flip side, we had one of our clients who actually sold, did an exchange, bought a condo, did not read the CCNRs until after close, quickly found out that he was not permitted to rent the property. It had to be owner occupied. So in that case, he quickly sold, did another 1031 exchange. He got audited by the California Franchise Tax Board. They actually allowed his 1031 exchange, even though he only held title for a month and a half, because he could prove his intent was to hold for rental, but there was a business reason why he couldn't. So those are critical issues. It all boils down to what you can prove should you get audited. There's also lots of misinformation on like-kind property. Like-kind is easy. It's real estate for real estate. That's all it means. It's not condo for condo. It is not apartment for apartment. It's not office for office. You're selling real estate. You have to buy real estate. Simple as that. Even things you wouldn't think about qualifying would be like oil and gas interest, air rights, water rights, mineral rights, etc. Anything that's considered real estate will qualify as like-kind property. The only real restriction is it has to be U.S. property exchanged for other U.S. property, or foreign property for other foreign property. It does have to be real estate. Personal property used to qualify before 2017. That was taken away with the Tax Reform Act of 2017. So exchanges we used to do in the past, like aircraft, shipping, trucking, vessels, machinery, equipment, we can no longer do exchanges on those. But you do have all sorts of bonus depreciation, accelerated depreciation, and write-offs and things. So with that, let's go right into Doug's question. And this is probably the most challenging part of the 1031 exchange world. First of all entities, all types of entities can do 1031 exchanges, including, corporations, partnerships, LLCs, trusts, etc. There's no limit on types of entities that can do a 1031 exchange. Having said that, the entities are owned by people, by investors. And so the question is, who's the real taxpayer? We have to drill down and find out who's the real taxpayer. And that's really the issue. So first of all, if you've got a corporation, whether it be an S Corp or C Corp, if you got a partnership, whatever it might be, if the entity sells real estate, the entity does a 1031 exchange and the entity buys the replacement property, that's a nice, clean transaction. It's the same taxpayer all the way through. What we find a lot is that the entity wants to break up. So I'm going to use an LLC as an example because that's the most common thing we see today. You have an LLC with multiple members, so it's treated as a partnership for tax purposes. They file a 1065 partnership tax return. Each partner gets a K-1. They report their respective interests on their tax return. It's important to know that the individuals do not own real estate. The individuals bought or invested and received a membership interest in the LLC. And because it's treated as a partnership for tax purposes, it's a partnership interest. If the entity sells property and distributes the cash, the partners can't do a 1031 exchange because they didn't sell real estate. They're just getting a cash distribution from the partnership. There are all sorts of ways to fix this issue. So the first thing is if you or your clients own real estate in some type of an entity, sit down, talk about your exit strategy. What do you think your exit strategy is going to be? Then once you've decided what that is, and I understand it may change, but at least try to predict what your exit strategy is going to be, then look at the way you hold the real property and see if there's a way or a change you need to address today so you can qualify for that exit strategy. So for example, if you own real estate in an LLC, going back to Doug's question, let's say it's in an LLC, multiple members, et cetera, and you know in 3, 4, 5 years from now, you're going to sell this asset and you want the individuals to be able to do 1031 exchanges or whatever they want to do, you could do what they call is just drop the property out. It's really a long-term drop and swap. You drop the property out, the LLC deeds the property to each person as individuals, as tenants in common. So they each now own an undivided X% interest as a tenant in common with everyone else. Hold it for a couple of years. Again, it boils down to intent. Did the individuals intend to hold the property for investment purposes? After 2 years, you've really demonstrated your intent. Then when you sell, you can do anything you want to do. If there's liability concerns, each individual investor can set up their own single member LLC, which is disregarded for tax purposes, and it's treated as if the individual owned the individual interest. So there's all sorts of ways of doing a dropout today and then later do the 1031 exchange. You could buy out a couple of the partners. So if the partners, the members, the stockholders change, but the entity does not, that does not harm the 1031 exchange. The entity can still do a 1031 exchange. So if 1 or 2 folks want out, there's ways to buy them out. There's different strategies you can use to buy them out, but the entity stays the same and does an exchange with what's left. One of the questions that came in pre-event is a drop and swap. There is risk with a drop and swap if it's done just prior to sale. There are some court cases that allowed it. There's court cases that didn't allow it. Some of the court cases that allowed it were ruled upon under the old California Partnership Act. So we assume the court would rule the same, but there's no guarantee it would. So a drop and swap is effectively you deed the property out to the individual members as tenants in common. They each own an undivided X% interest as a TIC. Then you immediately sell, immediately they each can do their own individual 1031 exchanges. The issue is, did the individuals have the intent to hold for investment purposes? So a drop with an immediate swap is a risk. That's where you have to get your tax advisors and your legal advisors to look at the transaction, get as close as you can to some of those court cases out there if you want to try it. The best advice is avoid a drop and swap so you don't have that audit risk and plan around it. If there's just 1 or 2 members who want out, you could probably do some type of a redemption agreement, buy them out, deed them their % of the real estate, and then at the closing, they get their cash, they pay the tax, they walk away. The partnership is the same partnership, same taxpayer identification number. They do the exchange and go forward. there's probably a whole bunch of different variations of that theme. And for today's seminar, or webinar, we don't have enough time to go into detail. So something like a buyout, a redemption, some type of strategy like that is probably a good solution to fix those interests. In some cases, you find the replacement property is owned by an LLC or a partnership. And for some reason, maybe it's tax credits, maybe it's some rights that the LLC has. Maybe the LLC has started applying for permits or what have you. And if you bought the property from the LLC, it may complicate whatever's going on over there. For your 1031 exchange, if you buy 100% of the outstanding membership interest or partnership interest from those investors, so you end up owning 100%, and that entity becomes a disregarded entity when you buy it at the closing, that would qualify for 1031 exchange purposes. There's a specific IRS ruling on that, but you have to buy all of the outstanding interests so it becomes a single member LLC or single member partnership and a disregarded entity. And that was a mouthful on entity issues. I'm going to kind of wind up now with a couple of just the final questions that were kind of thrown out there pre-event. And then any of the questions you might have, we can certainly take those. Someone had asked about what's the difference between a traditional 1031 exchange, a Delaware statutory trust, and net lease properties. So first of all, they're all part of a traditional 1031 exchange. So we do a regular, either traditional forward 1031 exchange, or we do a reverse exchange. They're all structured the same. The difference is the replacement properties you're acquiring are just different strategies, different structures, et cetera. So the Delaware Statutory Trust is a trust that owns one or multiple assets. Typically, it's a $40 to $140 million portfolio or single asset. Examples would be the Verizon data centers are in Delaware Statutory Trust. The ESPN headquarters is in a Delaware Statutory Trust. So a investor selling and doing an exchange into a DST, they're purchasing a percentage interest in the trust as a beneficiary, and that qualifies for 1031 exchange treatment. There's a specific IRS ruling on that. So that's one way to get rid of property management headaches and all of the landlord stuff you deal with, but it's still tax deferred. All the management is done by the DST trustee. On a flip side, you've got the net lease properties. With net lease properties, you are generally buying all of the property, the entire or 100% of the asset, whether it be a Taco Bell or a Dollar General or something like that. So you own 100% of it. You are actually buying the real estate itself. You're getting the debt, and then you own 100%, but you're getting one net check every month. So similar in terms of getting rid of management headaches, different in terms of legal structure, et cetera. So it really kind of depends on what your replacement property is. One of the other questions was selling assets in California, moving out of state. We've seen a lot of that going on in the last couple of years, especially 2020, 2021. The question was along the lines of, is there a holding bucket? So, and I think they were concerned about timing, and is there a way to put the money into something to hold it and then later do another exchange or move it when you find the ultimate replacement property? The answer is not really. You have to have the intent to buy and hold for investment purposes. So if somebody's structured a vehicle to acquire and hold or park your money, it really is not held with the intent for holding. It's really held for sale. So there's some risk there. Some people use the Delaware Statutory Trust as a parking mechanism, but that's really a 4 to 7 year hold. So it's not a great parking structure. Also, along the same lines as when you're selling California, you're going out of state, you've got the California clawback, which means that if you go out of state with your exchange, you're still tax deferred. You still, though, now have to report to California as to the status. As long as you defer the tax forever, you never pay California. But if you sell and cash out, you will pay California taxes. Failed exchanges, the question was, do they fail? How often? You know, we've tracked ours. Historically, it's only about an 8% failure rate. I would guess, we haven't done it in a couple of years, but I would guess today the failure rate is probably in the 12 to 15% range, maybe even a little higher because of COVID and the challenges we've seen there. Most common reasons for that is you can't find replacement property. It's a really tough market to find property in, or it's a due diligence issue, or it's a lender financing issue, are the most common reasons for a failed exchange. We had a question about, can you exchange into a Reit? Yes, question?
Yes, Bill, could you tell us how much are these 1031 accommodator fees going in and exiting?
Good question. Most exchange companies are in the range of, say, $750 to maybe the high side of $1,200 for a regular forward 1031 exchange. And that should include one sale and one purchase. We're at $899, and that includes the sale and the purchase, and it includes the qualified trust account. The further east you go, the higher you're going to see the fees. There's less competition and more of the QIs are attorneys back there, so they charge more. But for the institutional qualified intermediaries like us, you're probably looking at $750 to about $1,000, maybe as high as $1,200. There's usually also an additional property fee of $200 to $400 per additional property above the first one. Let's see, I think there's just two more. Oh, go ahead. Was there more questions?
I think that's all for now.
Okay, I got two more, and then we can take any other questions that might come up, because I know we're right at the 1 o'clock mark. We had one question of, can you 1031 exchange into a REIT? And I kind of joked no and yes. The REIT is a security, so you can't sell real estate, do a 1031 exchange, and buy units or shares in a REIT. That's considered a security interest. But there is one exception, and that's called an UPREIT, UPREIT. The UP stands for Umbrella Partnership. It's a multi-step process. You sell, you do a regular 1031 exchange. Instead of finding property that you want, you buy a fractional interest in a very large asset that the REIT has picked out. You buy a tenant in common position in that asset. So let's say you buy a 0.5% interest in the REIT or in that tenant in common asset. That's the first step. That's your 1031 exchange. There's a holding period of 1 to 2 years to demonstrate intent to hold. Then the second step kicks in. And that's the 721 contribution. That entire asset with all the investors is contributed into the umbrella partnership. And that's how you become part of the REIT. The benefits are that you're now part of the REIT. You get the cash flow, the diversification, et cetera. Two huge negatives. One is you're now in a security. You can't 1031 exchange again. The biggest one from my perspective is if the sponsor sells the property you exchanged into, that will trigger your gain. So you don't see a whole lot of UPREITs out there because of those risks. Sometimes they'll make a pledge not to trigger your gain for 7 years or 14 years, but in most cases they're going to trigger that gain if they decide to sell. And the last one is foreign property. And I wasn't quite sure where the question was coming from, so I expanded on it. I think the question was coming from the perspective of what about foreign owners of U.S. property? So a foreign person owning U.S. property, they could certainly do a 1031 exchange. It's more complicated because of their status, they probably are subject to FIRPTA withholding issues. So we have to address that right off the bat. There's a lot of complexities there. There is an attorney that we work with here in California that does nothing but FIRPTA issues. And so that may be one way to address it. But there is going to be some withholding issues. There's timing issues, et cetera. So we can go into more detail if you've got a client who's subject to FIRPTA, but they can absolutely do 1031 exchanges. The flip side is usually a U.S. person or somebody with a U.S. tax consequence is selling a foreign property. They can also do a 1031 exchange. Contrary to popular opinion, you can sell foreign property and do a 1031 exchange as long as you reinvest in foreign property. So it's got to be foreign for foreign. That can't be done. We actually handle those. We do a couple of them every month. Most exchange companies won't touch them, but we will. There are foreign currency issues, things like that. So we have to go through the process and look at the closing procedures in that country, but it can certainly be done. And part of the question too is also about double taxation. Generally, there's not double taxation. If you're a California resident, what happens is you sell the U.S. property, you trigger the gain, you trigger a tax, you pay whatever tax you pay in the foreign country. Then here in California, you calculate your California tax or your U.S. tax. And you usually get a foreign tax credit. So you don't get double tax. You're just going to pay basically at the higher tax rate. There's a lot of moving parts there. So that's where the tax advisors have to come into play. But it's not really double taxation. It's just the higher taxation. And failed exchanges, we kind of covered that in terms of reasons, et cetera. The biggest one I didn't touch is the last item there. When are they taxable? And it depends on when the taxpayer has the right to receive the funds. So if you're closing toward the end of the year, your 45th day lands next year, or your 180-day period it lands next year, and your exchange fails because you may not have the right to receive the funds until the following tax year, you might be able to defer the tax consequence into the following year. So we'd have to look at the specific transaction and see if that actually allows you to defer the tax into the following year. And that is a wrap, at least in terms of the comments I've got, and I'll turn it over to any other questions.
Okay, guys, now's your chance to get any final questions in. And seeing none at this time, a big thank you from CCIM San Diego to our speaker this morning, Mr. Bill Exeter. Especially Bill, thank you for sticking it out. We know you had a bit of a cold over the weekend, and what a professional to come on and still stick with the program. There will be your information that's here on the screen will also be sent out via email along with the replay link. So be on the lookout for that. If you have additional questions or if you are interested in having Bill's company manage a 1031 exchange transaction, I know they also like to provide strategies and strategy sessions. I think that's what differentiates them from their competition is, as you can see, Bill really knows this industry inside and out. And when dealing with the IRS, or even worse, the Franchise Tax Board, you're going to want someone that knows it inside and out. So certainly reach out to them for any advice. And then also, if you have never seen a guide to 1031 exchanges, this is Bill's booklet that has all of the answers, really the basic information on 1031s. And if you don't have a copy, we are going to be including a digital version of the most recent version of this booklet in the email that we send out. So again, thank you so much, Bill, for coming on and putting on this great presentation. And of course, maintaining your sponsorship level with us here at CCIM San Diego.
My pleasure.
We're happy to have you. And again, thank you, Paris, for being a wonderful co-host. And of course, we always have to thank Ellen Ernst, who is our CCIM administrator, for the behind the scenes. Thank you so much, Ellen. And for CCIM San Diego, for Periscope, I'm Doug Tabor, and we look forward to next month for you to join us for another wonderful CCIM Lunch and Learn. Have a great month, everybody, and see you then.
Thank you, everyone. Goodbye.